All right, welcome everybody. It's time for our quarterly review of economic and market conditions and our outlook for how we see things coming up for us. I'm here with Brian Regan, our portfolio manager. And hey, Brian. So we've got a good presentation. Why don't we jump ahead a couple of pages, Brian, and we'll get to the content of the plan for our day together. We thought we'd give a little bit of review for everyone, not just of the past quarter, but of the year as a whole for last year. We'll of course go through the fourth quarter in some detail, but we've got a little bit of a breakdown for a summary of review as well. In addition, we've been getting more questions about political-oriented, context and how that might be affecting portfolios, what people might want to expect. We've done a longer webinar on that topic for our clients on our website, and we will just give you a little summary of some of the thoughts that we came up with there. And then, of course, we want to talk about what to expect in the year ahead. And so Brian's prepared quite a bit of great content to give you some insights as to, what are things that we think are good news, and what are some things we have as things to be paying attention to for concern. And then we'll work into our outlook for what's this mean for our portfolio decisions as we're adjusting our strategies. And for those few people who have our more tactical considerations in some of our particular strategies, we'll identify later at the end. We'll just go through some of the changes that are happening there. If there's time, we may briefly identify some of the impact of the Secure Act. And of course, Brian, we didn't work it into the presentation today, but we got some good things happening with the stock strategy, and you might want to just mention some of that as well in terms of how you think about what's happening with our stock strategies as well.
Okay.
So let's jump into it. And so, in the environment we're in with the political situation, our goal here is not to talk about any kind of objective that we're not trying to convince you of a political outcome or what we think is our preference of any kind. All we're trying to do is evaluate, given current polling data and the information that we can assess today, what does this imply for how it might impact portfolios? And of course, polling data can change, and in some cases, it's not always accurate. Remember, in 2016, polls were not as reliable as they have been in previous years. So, we have to take some of this with a grain of salt, but given what we can discern, this is what we're going to review. So the bottom line for the way we're looking at things was that, what's likely to happen in Congress? And based on current information available, it still looks like it's not likely to see a turnover in the House or the Senate in terms of who's in control of either chamber of commerce. And ultimately what that Congress, and what that ultimately implies is that we're going to have some measure of divided government. So irrespective of who wins the White House, it's not going to be easy to move legislation or any kind of extreme changes in one direction or the other. So from the market perspective, markets like predictability oftentimes. And so we think that bodes relatively comfortably for the market as we look ahead, that it would not be political disruptions that will drive the conditions that might change things. Now, that being said, we're in the midst of an impeachment hearing trial that's going on in the Senate. And, irrespective of what is the outcome right now, it's pretty widely expected that President Trump is not likely to be removed from office. But even if there were to be a situation where the president was removed from office, we feel like the likelihood is that a Pence administration over the next 10 or 12 months would not really look a whole lot different from a Trump administration in terms of policy agenda. And so that being the case, it seems more likely that things are going to be pretty predictable. And if they're not, if it comes to these kinds of issues, may actually present some opportunities for our selling or buying opportunities that we might look for. More on the lines of buying opportunities. Thanks. So when it comes to this particular visual we've got, this slide, really it's just trying to point to the notion that we have to pay attention to the Electoral College. And when it comes to the Electoral College, there's some pretty ingrained expectations for, where we're going to see red states and blue states. And there's only a handful of states that look like they're more in that toss-up where depending on how these turn, could really define the outcome of the election. And so, I'm sure the experts will have it down to the counties and so forth, but at this point, these are the states we're watching. Brian, why don't you comment on this this page as far as what this implies?
Sure. So the slide before talked about how there were 4 or 5 states that really mattered when looking at the states that are going to turn the election. This slide is the net approval of the president by state. So blue means that they generally have an approval of the president. Red means that you generally have a disapproval, and every shade in between. So looking at this chart, which is a daily survey done by Morning Consult, it looks like it's close to the top right now, but the key states are leaning against the president right now.
So we'll keep watch on that, and with the issues relating to how things might change when it comes to the Senate and House, which these things are subject to change. We envision maybe we'll do an update of our political commentary, how it might affect portfolios sometime after Super Tuesday. Let's see if we get some direction where we can see likely outcomes and see if anything material has developed when it comes to the congressional outcome. So let's move on to 2019 and some of the impact of the year we've had. And Brian, why don't you review with us all the particulars of how we made some of the changes. We talk about active allocation, the phrase we use when we talk about our strategies and our process. Let's illustrate some of the ways in which the decisions we've made have turned out.
Sure, it's always good to do a little post-mortem, I think, at the end of every year. It's kind of what I'm attempting to do here, breaking down quarter by quarter what we did, what worked out, what didn't work out. If a comment's in green, it means that generally speaking, the positioning really worked in our favor. It was a good move. If the position's in blue, it might not have been the perfect decision, but it still had positive performance. And if the comment's in red, it means that the decision moved against us, and we actually had negative performance for that particular decision. Luckily, in a year like 2019, I don't think there's any red on this chart, so we have that going for us. What's that, Chris?
I just said good news.
Yeah. So going back to Q1 of 2019, we'll do a little blast from the past. The market was roaring back from a 20% downturn. So in Q4 of 2018, there was a significant downturn. The 10-year Treasury was at 266. In contrast, it's at about 171 as of today. Theresa May was the prime minister, and she was trying to get her Brexit deal passed with the European Union through Parliament, and was struggling to do so. Early tariffs were in place, but generally the headlines were muted and didn't get more significant until later in the year. So what did we do? Well, we extended our bond duration in the AMR portfolios to take advantage of the longer rates with the expectation that they were more likely to fall than rise significantly. Bond yields have rallied significantly since then, from 266 down to 171 today. We were more extended in the bond duration in the first half of the year, which really helped us. We increased our all market exposure significantly, which cut internal fees, and we were able to capitalize on the market recovery since it's a little slanted towards growth. This is really a risk-free benefit while still participating in the stock rally. We eliminated unsecured high yield for investment grade duration. When you see the 10-year treasury fall as far as it did, this was undoubtedly a good move. High yield still performed well throughout the year, but it had a kind of a rocky path to generate a similar type of return that investment grade did in pretty much a straight line. Q2, we saw the top of the Fed funds rate. So the Fed stopped increasing rates. You may remember that in Q4 2018, the Fed was raising rates. In Q2, the Fed came out and said that they were no longer going to continue to raise. It's a kind of a step process, and they say they're going to be patient, and then that leads to cutting later in the year, which is what we saw. The Eurozone PMI fell into contraction. Brexit and tariffs issues continued. Tariff issues got significantly worse in May, and we saw a little bit of a correction because of that. The market had reached fair value. The 3-month and the 10-year treasury had inverted. We continue to higher than normal duration in the investment grade bonds to take advantage of the falling rates. Like I talked about previously, we maintained that exposure in Q2, and that continued to be a really good move as we were at 266 at the beginning of Q1, and we fell all the way down to 2% on the 10-year by the end of Q2. So it was an excellent move. We decreased our money market fund for short-term bonds, which is beneficial. So we were in the money market fund when the Fed funds rate was going up because it effectively worked as a risk-free floating rate bond for us, which worked out nicely as the Fed was raising rates. We went from 1 to 2. But as the Fed started getting ready to cut rates, it was not going to benefit from the raising rates that was happening in 2018. Yet short-term bonds were going to have a little bit of benefit from falling rates. So that trade, that slight difference in asset selection really helped us there. We kept the stock exposure neutral, but in late February we added more emerging markets. So throughout 2019, we've been underweight international stocks, particularly because of Brexit and tariffs. They've been attractive from a valuation perspective, but with just a lot of political uncertainty, which led to earnings uncertainty, led us to keep away from that. In late February, we were completely out of the emerging markets, and we decided to put our toe in the water a little bit because the president seemed to hint at some resolution with the tariffs. We benefited from having low volatility position, which was USMV in your portfolios, which happened to outperform the market due to the sell-off in May. Q3, Federal Reserve began the lower rates, so they hinted at it in Q2, and they actually started doing it in Q3. We expected the yield curve to gradually steepen, so it had fallen pretty much parallel down in a straight line from the highs in the 250 to 260 range down below 2, and it was even inverted at one point. So we started expecting a flattening, then a steepening. So in global PMI began to fall in contraction territory. So following Europe, the entire global PMI started to do it. We added gold to the portfolio in anticipation of a falling dollar as the Fed funds rate got closer to the zero bound. So generally, when interest rate differentials start to contract, it can make gold more attractive, especially if the dollar starts to fall, which is what we've been seeing as of late. In this quarter and in prior quarters, actually, gold had outperformed the total stock market in all types of fixed income positions. So, it's another great way to hedge your position, where, especially right now, it's become very expensive to hedge your stock market positioning. We've increased economic tactical position at low beta exposure. this is another way to stay invested without while hedging slightly. We're still in stocks in the economic tactical position, but we're in healthcare, utilities, and now going into the next quarter, MLP positions, which we expect to have some stability, but also expect to perform as similar to how stocks are expected to perform. In this quarter, utilities far exceeded the performance of the market. And in the fourth quarter, you'll see that healthcare far exceeded the performance of the market. So having both positions have worked really exceedingly well in the second half of the year.
It's worth just pointing out that these are generally modest positions. And, in the case of like commodities with gold, it's not necessarily something we would have permanently. It's more because we see it as something opportunistic right now. Wouldn't you agree, Brian?
Yeah. So gold, doesn't pay an interest rate, which is my biggest problem with it, as opposed to a bond position or something like that. So if we had interest rates that rose in the longer end of the curve to some sizable real rates, we'd probably exit the gold position and move into longer-term bonds. Now we doubled the low volatility position and we lowered the mid cap, small cap, and growth positions. Again, a way to hedge the position while the yield curve's flat. When the yield curve's steeper, it's a little easier to take more volatile positions. Low volatility outperformed and continued to outperform in Q3. We lowered duration to the kind of the historic norm that Chris has been in for years at the end of the quarter. And we've been in that position now waiting for the longer end of the curve to steepen. And like Chris mentioned, that this is one of the reasons why we're in the gold positioning. The timing hasn't been ideal, even though that we've had some yield curve steepening. Didn't really start until Q4, but all the fixed income positions did have positive returns. So that's why we get that blue text there instead of green. So Q4 2019, a little more fresh in our memory, so we can go a little more in depth on those. So Q4 was a tough quarter to read. Our theme was the market was at an inflection point. The bond market was kind of signaling a recession. Consumer confidence was positive, but it was getting worse. It was trending lower. The labor market was healthy, and business investment was negative and getting worse. You could make an argument that ultimately a lot of these trends are still valid. With the exception of consumer confidence, I think it's getting a little bit better rather than getting worse. So we have that going for us. But business investment is certainly negative and getting worse still. But PMIs have picked up a little bit. So we have, as we get into the slides here further, you'll see that we have some good news and bad news. And I think the good news outweighs the bad news a little bit here today, where it was probably really even at the beginning of Q4. So we want to stay invested, but more defensively. Again, this is about low beta exposure, having the economic tactical things, the low volatility positions. So they performed well, not as well as they did in Q2 and Q3, but we did have some outsized performance by healthcare and gold. And we moved into the floating rate bank loan position, kind of in lieu of some equity position that we might have in the risk allocation. Floating rate bank loans are typically middle market companies, higher credit risk. You expect a little performance out of a position like that, a little income. And it performed about 2.5–3% on the quarter, which is like a 10 to 12% run rate for the year, which under normal circumstances would be considered a really good positioning. But when you have the domestic stock market return, 8.75% in one quarter, it clearly didn't perform up to the standard of the domestic equities.
But as a whole, for the quarter, our numbers were looking relatively good for the year, rather. And in the quarter, it was just not as strong, in part because of those kind of considerations. I think it's worth. Oh, sorry. I just think it's worth just reminding people that, you mentioned earlier, Brian, that it was kind of a mixed bag when we started the quarter. And, when we're faced with that challenge of, unclear signals and, kind of even money as to which way things might break, we're more likely to try to err on the side of caution, protect downside a little bit more first. We'd rather have clients perhaps miss out a little bit on upside as long as they're not losing as much on the downside. So that kind of flavors our thinking and how we try to position things. Sorry to interrupt.
And there's good reason for that, Chris. I think it's a very important point. And the reason being is if you lose 10% in your investments, you have to make 11.2% back just to get it back. So losing money is really detrimental to your long-term wealth. So it's almost better to show up a little late to the party than get in a car accident by running the red light.
And that's assuming you're not withdrawing any money in the midst of that, right? With those kind of circumstances that you're describing.
Right. And the bigger the drawdown, the harder it is to come back. So, for example, if you have a 50% drawdown, which, luckily we don't have again in my lifetime, you have to make 100% back just to get back to you. So it's important not to lose money. As Warren Buffett says, rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1. So global macro, we talked about how we've been underweight. We've been underweight international positioning against the world ACWI. The ACWI is the All Country World Index, which is about 40%, give or take, international stocks versus domestic stocks. We've been significantly underweight that throughout the whole year due to these political issues. And this has been a winner throughout the whole year being underweight. But in Q4, it was actually, it was neutral. I mean, the domestic stock market did fantastic. Like we said, 8.75%, but it was beat out by the emerging markets by a little bit in this quarter. So the emerging markets had a nice little comeback in Q4. And we weren't out of emerging markets, so we did participate in that rally a little bit.
Yeah, we were invested in that, but just not as much as I might have been.
Right. And again, in fixed income, I talked about how we expected the curve to steepen, and it started to steepen a little bit in Q4. We saw the short end fall about 10 basis points and the long end rise about 24 basis points. So if you were in intermediate treasuries in Q4 to a significant degree, you lost about 1%. And I'm pretty happy with our bond positioning because all of our fixed income positions delivered up a positive performance, and the defensive position that we had in gold proved to be very, very good too. So what do we have on tap for 2020? We come up with themes every quarter. I'm not very good at it, but Chris is usually the wordsmith on the themes.
You did a great one with this one. I like this a lot.
So this one, he was proud of me. I getting a little bit better with my New Year's resolutions and conflicts. So we had a lot of good news, a lot of resolutions, but there are a few conflicts that we're always going to have our eye on. And I think it's important to point out that almost no matter how good things are or seem, I'm always going to find a few conflicts. We did this presentation live, and one gentleman didn't necessarily like the fact that I had some conflicts to speak of, and I'm always going to find something. So
yeah, I mean, I think his point was a good one in that
he had a lot of good points.
When you listen to commentary, it seems like, gee, there's a lot of good things happening, and in all fairness, there really are. There's plenty of things to be happy about. But our job, really, Brian, is, as you are mentioning, is our job is to be looking around the corner for what do we need to be aware of, what should we be careful about. And so, you're doing a good job explaining these issues as we go through this here. So it's not that we're pessimistic or negative or anything like that. There's a lot to like about our current situation, but there are some things to be sensitive about, and we want to point those out and why what could be the issues that could be problematic ultimately.
Yeah, well said.
So you want to do that on this page, or you want to keep going through the slides?
Let's keep rolling. We'll start with the resolutions, and you want to take this one on?
Yeah, sure. So,
With it?
one of the things that we can feel pretty good about is to see that in the UK, because of their recent elections and so forth, there's more clarity about what's going to happen with Brexit. And I think it takes a lot of the mystery out. We've got an expectation of pretty, clear outcome that at the end of this month, we're going to see the UK pull out of the European Union and negotiate their trade agreements going forward. And that's giving us some sense of comfort now to know what to expect, how things are likely to play out. And that gives us a little more enthusiasm about the prospects of how to invest perhaps in Europe, both for the UK and for European circumstances. So we'll see how that factors in a little bit later on. But some encouraging news there. When it comes to trade issues, we saw the signing of the USMCA, and in the particular issues with China, we saw the phase one. So a lot of the worries of the trade negotiations with China we're starting to see some manner of resolution. Phase one is supposedly the easier part of the whole process. There's still a lot more to do, and that can create some challenges, and won't be surprising if it bubbles up again. But at the same time, given an election year, it's probably counterproductive to see a lot of escalation in trade tensions. So for the time being, this looks like there's some good things happening here, and the essence of it is we've got a lot of the tariffs that we have been imposing are diminished and not escalated the way they were expected to. And Brian, why don't you walk through those particulars, and the idea of what is about 200 billion or some significant amount of purchase of goods with us in the U.S.
Yeah, the headline was $200 billion worth of goods, but I don't think they've released the specific details of what. There's supposed to be $32 billion worth of agricultural goods, and that's over the next 2 years. And this is a significant jump from what they normally do of about 50 billion. Again, it's a little light on the details of about what the products will be and what we can expect. But agricultural goods, they definitely do have a pork shortage, so I think we can expect that.
And the bottom line is, though, that the fact that U.S. consumers won't be paying as much in tariffs is a good thing for the economy, and the fact that the Chinese will be buying more U.S. goods, also good for the economy, whether it's agricultural or otherwise. So, devil's in the details. Let's see how it all plays out for real, but looks promising at this point for some potential stimulus in terms of how that plays into the U.S. economy.
Yeah. The only thing I want to add is I think some people get confused and think that this is eliminating tariffs. This only eliminated one threatened tariffs and cut one of the existing tariffs in half. So there are still significant tariffs in place with China and with other countries, actually. There are tariffs in Brazil, for example. So things to keep an eye on. So this is part of the global macro landscape, and I think this is one of the bigger things that have been driving the market higher lately. There's been a rush of liquidity into the market over the last 6 months. And you can see that the net number of central banks, that blue line there, have really been cutting interest rates. And this is indicating that the last move was a rate cut rather than a raise. And typically, you can see that global manufacturing PMIs are pretty well correlated with that. So hopefully you can expect to pick up for some economic activity due to liquidity being around in the marketplace. So be interesting to keep an eye on. And that's also one of the risks of the market, if that liquidity starts to get tamped down now that things seem to have picked up a little bit. Again, more good news, emerging market economies. I want to concentrate on the blue line in this chart. If you get over 50, that means that there's general positivity with folks out in the marketplace for manufacturing. Emerging economies, it's a pretty good indicator to concentrate on the manufacturing part of the PMI, and with domestic economies, or advanced economies, you want to discount that a little bit. But as you can see, the blue line well above 50 now. So good news there for sure. You could see in 2019 we had dipped below the 50 line twice. Here's more good news. In Q4, we talked about how consumer confidence was positive but getting worse. So you can see in the magenta line at the top right, the United States, kind of fell off a cliff there in Q4, and has had a significant rebound, kind of almost taken back all the confidence that they had lost in Q4 has pretty much come back and throughout the quarter there. The Euro area countries are still positive, kind of flatlining, and the United Kingdom, due to Brexit, looks like it's really had a nice uptick as well. Still not quite over that 100 mark, which is the difference between positive and negative confidence. But generally, I think we've seen a significant improvement in this in the last just couple months. Again, I don't think it's a coincidence that consumer confidence and the unemployment rate should be, almost mirror images of each other to a certain degree. We have rock bottom unemployment right now. A lot of economists didn't even think it could get this low. But I'd also like to point out that wage growth has been rising as well. So that's good and bad. Workers have more money to spend. But for corporate profits, it means that they have lower margins, which is something that we've been seeing even into Q1 earnings here. We saw it throughout 2019 and it's starting to continue here in Q1 earnings. So when I talk about the conflicts that are coming up, it's going to be a big theme, what we can expect for earnings, because the market's had a nice run, and what we really want is for earnings to keep up with prices in the market, so no bubbles form, and we can continue to be bullish on markets. So, before we get into the valuations and what all these positive news is how that's gonna impact your portfolios going forward, we're gonna talk about some of the negative things that we're seeing in the market. This is advanced economies. And you can see the manufacturing blue line there is negative in advanced economies. Again, not as important as the other two lines, where emerging markets it's a little bit more important, but still, something of note. Definitely a conflict, if you will, if you're looking for things to pick on in the market right now. The European PMIs are still not great. The United States PMIs are getting better, but still not great. So, something to keep an eye on. It looks like we're having some improvement, but not out of the woods yet. Business confidence, this is really the big one. I think this is what I think the PMIs from the prior chart and this chart are really telling the same story. And I think the next chart will as well, that business leaders don't have the same confidence that maybe consumers have yet. And hopefully that comes back. There's a number of reasons for that. I think, tariffs don't help. I also think there was a big inventory build after the corporate tax cut. I think, wage growth cutting into margins is definitely a concern for people. You hear about raw goods costs rising, which is a little bit surprising given the CPI numbers. But there's a host of reasons why, folks have started to trend negative here. The corporate tax cut, the fact that they had such good 2018 because of it, it's tough to compare your 2019 and 2020 numbers to those 2018 numbers too, which makes people feel a little less pessimistic as well, a little more pessimistic as well.
Well, it's worth reminding people again too that when it comes to economic prospects, the consumer is really important because of that 70% we tend to say consumption, driven in the economy. So, as much as this is an important indicator because it could be predictive if it doesn't, improve, as long as the consumers are still spending, the likelihood is it's still going well. but it's a question of what are those business leaders seeing around the corner, or what's causing that pessimism that could be creating some question mark for us to be paying attention to, as to will that have an impact on future improvements in unemployment or wage growth, or all the things that could be issues.
So this is kind of more of the same story. This is CEO confidence. I think these are two sides of the same coin when it comes to business confidence and CEO confidence. Right now, below 45% of CEOs surveyed are confident in the economy moving forward. Generally speaking, this has led to negative earnings when looking at the period between 1976 and 2019. Since we're going to get into earnings in the next couple slides, we really want to see some earnings growth to keep pace with the price increases that we've seen throughout 2019. So earnings are going to be a big theme of this presentation really for the remainder. So talking about earnings again here, this is the Nasdaq 100 QQQ in your portfolios. Over 40% of the companies in the QQQ have negative earnings, and you can see this is one of the peaks. We saw something similar in 2016, 2017, 2013, 2014, certainly during the financial crisis. So it's not unheard of, but it's not ideal. I mean, obviously, we would like to see some of these growth companies that are putting up some big numbers in the stock market to actually have some earnings growth behind it, or even earnings at all. Chris, you want to take over the?
Yeah, and so that those kind of thoughts enter into our decisions about how much of holdings like that to maintain or not. Well, we mentioned earlier that things generally internationally were encouraging. But over the last few months, or last month or so, we've had this issue where tensions with Iran seem to be bubbling up a little bit. And of course, we're not in a position to assess the merits or the benefits or drawbacks of these issues. What we're really looking at is saying that it doesn't seem likely that this tension is resolved. I think we saw some missile attack to respond to the Soleimani assassination, but will it be done through surrogates? How will it happen? We don't know right now, but it does seem likely that some of these tensions are still escalating and not necessarily resolved. And so we think that may be relevant for how we think about some of our investment decisions, particularly when we think in terms of some of our more tactical or more aggressive portfolios. So we'll come back to that a little later.
Yeah, Chris, I think you've mentioned before that this kind of falls into the known unknown categories. And,
yeah.
I think the virus in China can fall into that category as well.
Yes.
Going on as we speak.
Yeah, makes you wonder what's going to come next with that. How is that going to progress, or is it going to be isolated?
Well, it's going to cut down on travel. It's definitely going to cut down on economic activity in those cities. It's 35 million people, which doesn't sound like a lot for China, but it's our 8 biggest cities combined. So it's not a small amount of people in economic activity. So we just went through a lot of economic data, the good and the bad. Like we said, probably leaning towards the good. So now, how does that play into financial assets and the prices? Well, we've seen a huge run up in financial prices over the last 3 months, as we talked about, with even the emerging markets outpacing the domestic markets. The domestic markets putting up a big number, about 8.75% over the fourth quarter, and it's frankly continued until today. The market's down pretty significantly today, but it's been a good year to date so far. We're doing this on January 24th. So, this chart basically says that by every measure except earnings yield spread with triple B yields, the market's expensive. And even with the earnings yield spread to triple B yields, what's more likely that stocks are going to fall? Triple B yields are going to rise, or that stocks are going to continue to rise. I think it's far more likely that triple B yields rise, since they're even at a tighter point than stocks are. They're even, from a historical standpoint, probably the most expensive that they've ever been, from what I can see.
Before you go on, I just want to explain that a little better on the what PE refers to. Sometimes you and I take it for granted, but some of our viewers may benefit from just a little bit of an explanation. So, when we talk about forward earnings price.
Chris? Oh, it looks like we lost Chris there for a second. He's explaining price to earnings ratios. So the price to earnings ratio,
Half times the number.
Yes, Chris,
yeah.
I'll stop you there for a second.
Sure.
You paused out on the video.
Oh, sorry about that.
It's okay. So I think you want to go back and explain the PE ratio.
Okay, so what I was saying was, when it comes to the price to earnings ratio, what this is assuming is based on the anticipated forward earnings, the market, the S&P 500 is trading at 18.5 times that earnings as its price. So the average over the last 25 years is more like 16.25 times. And so it's just telling us that things are a little bit over valued. So either we need to see earnings improve in a way that they will catch up, or maybe increase greater than expected to justify the current valuations in the market, or it's possible we may see markets pull back some, or just stagger along at the current levels until those earnings start to catch up. So there are a bunch of possibilities, but valuations are implied to be a little bit high, and we really depend on seeing what's going to happen with earnings to determine whether they're going to be justified, or if we start to see some disappointment from earnings that they don't reach. What did you say, Brian, previously? There's about a 9% assumption built into that?
Yes.
So, we're going to need to see some growth in earnings that either exceeds that or at least keeps up with that, or wouldn't be surprising to see a little bit of a market pullback.
So, Chris, we talk about the differences between investing internationally and investing domestically, and we've talked about how we were very underweight international markets going into throughout 2019, and quite frankly, that's going to change here starting early in 2020. We're still probably going to be a little bit underweight, but we're going to add rather significantly to the international exposure in stocks. I think it was justified to have the international market lag the U.S. market over the last few years. You can see that the earnings have been far more consistent in the United States. There's a couple of reasons for that. It's a much more diverse market. The demographics are generally working better for the United States versus somebody like Japan or Europe. And we also had a big corporate tax cut in 2016, which had a big impact on earnings. To belabor that point on this slide, the historic difference in PE ratios between the S&P 500 and the ACWI ex-US, just the international part of the ACWI, is 88% on a 20-year average. And today we're at 77%. So typically there is a discount for international equities, but there's even more significant discount today than is typical. And to that point, we're almost getting twice as much dividend yield from international stocks than we are from the S&P 500. So, I think that speaks to a lot of folks who like to get their quarterly dividends. This chart just kind of belabors home the point that earnings growth and earnings growth expectations have really fallen short over the last couple of years. What you really want to do is just kind of concentrate on the blue line. Those are forward earnings expectations currently. And you can see that the line's really plateaued between early 2019 and today. And realistically, I think we can expect that line to dip a little bit in 2020 because that is the trend. As you can see, that little red line trending down for 2020 where it meets the blue line. So I think we're going to see forward earnings dip a little bit, which should have a slight impact on the market. That doesn't mean that we're not going to see earnings growth. It means that we're more likely than not not going to make the expectation that's currently baked into the forecast. And that's just based on history. People typically start their forecast very optimistically and then adjust going forward.
Yeah, that's a good point.
So the yield curve, complicated subject, so I won't spend too much time on it. If you want to learn more about it, give me a phone call. I'll talk about it all day. It's one of my favorite subjects. But basically, when you see the progression of the lines, and the yellow line was 1 year ago, the red line was 6 months ago, and the blue line was just a few days ago. When you see that progression going down, your investment grade bonds have done very well. When you see those lines start to move up, they do less well. But the part on the left side of the screen can stay low, and the part on the right side of the screen can rise. And that's what I'm expecting to happen. And that's typically what happens in very healthy markets. So if you believe that the market is improving right now, which I think we do, we have more cause for optimism, we would expect the yield curve to steepen. And that basically means that it'll look like a nice rolling hill if we get the steepening expectations that we expect. And that means that we want to be positioned on the lower end, because as the higher end goes higher, then we lose money on the longer end. So we want to be on the shorter end for the most part. It doesn't hurt to have some exposure to the longer end because of it can protect your portfolio. So we have a little bit of a mix of both right now, but a preference to the short end.
Just pause there for a second. So, one of the things I just want to kind of reiterate a little bit is, one, when you think about it, it's important to recognize that you can have different expectations from the economy and the stock market. So, a lot of what Brian has just outlined are, for the most part, pretty good news when it comes to the economic outlook. There are things that we're watching and sort of could be, trouble areas that we want to pay attention to be ready for should they develop into something more significant. But on the whole, the economy looks to be pretty good, in a good position right now. On the other hand, when it comes to the market, we've had really a great more than 10-year run now. The thing we have to be recognizing is, after a big year like we just had, numbers are pretty high, we really have to see those earnings justify future growth in the market. So we really want to watch to see how that plays out, and we're hopeful that those earnings will increase sufficiently to justify that. On the other hand, if markets continue to rise without that, that becomes a little bit worrisome and problematic. If we don't get good earnings or we get disappointments, it's also very possible that could trigger some market disruption. Now, that's not always a bad thing. That can create some opportunities along the way for what we might want to, how we want to position the portfolio. But these are the things we're watching for. And when it comes to the fixed income environment, Brian's very adept at identifying these issues of how are these forecasts of changes likely to impact how we should be thinking about where there's opportunity and where there should be some defense. This changing rate environment, as much as the Fed may not be doing a whole lot, we're seeing the bond market move, and envisioning that steepening of the yield curve has a consequence to existing bonds, and we want to be positioned in a way to either be more defensive around that or benefit from that. So those are factoring into some of the decisions we make, and also has a consequence on the way we position the portfolio, on both sides of the risk profile of the stock and the bond positioning. So I just wanted to reiterate some of those concepts, Brian. Now, the commentary you're about to undertake right now probably doesn't apply to all of our clients. It definitely applies to those people in our more aggressive strategies, things like our 85-15 strategy and our 60-40 core explore for moderate growth kind of design. So why don't we talk about that, and then we'll circle back and maybe touch on the Secure Act briefly.
Okay. So we're going to maintain the gold position. It's done, generally speaking, what we expected it to do. We've seen a separation between the dollar and the price of gold, and we're going to continue to I expect that to continue with an improvement in trade deals and in Brexit. We can expect those foreign currencies to move favorably against the dollar, which should support gold. It's also a natural hedge when we can't really go further out in the yield curve, and we're running out of affordable natural hedges in this market. So it's a good addition to a portfolio. I'm going to go pretty quickly through the tactical allocations here. People might find them just generally interesting, but like Chris said, they probably only apply to some of our more aggressive portfolios. We've been in semiconductors in our 60-40 strategy. It's really done really phenomenally well, and I do think that there's some value there in a lot of these companies, and we're going to maintain that position. We entered financials about 6 months ago. There was really some opportunity. We saw Bank of America and Berkshire Hathaway in particular that looked very attractive from a price, from a valuation standpoint. They're more fully valued today than they were 6 months ago. And since we're trying to find in this tactical positioning really cheap sectors to move into, we're going to move out of that one for now. And we're going to move into energy. So energy has been very beaten down. And in this ETF in particular, you're going to get a lot of exposure to Exxon, Mobil, and Chevron, which have very attractive dividend yields. I mean, we're talking 5-6+%. And I'm hoping that the market catches on to these very profitable, fully integrated companies, and they rally sooner rather than later. So for the momentum subsector, we're looking to do something a little bit different here. We're looking for sectors that are doing really well, and we're going to try to continue to ride that wave. The usually secular trends that we're following. We were in healthcare and medical devices. Medical devices is a little bit of a smaller cap fund, while healthcare equipment was a little bit of a larger cap fund. Healthcare equipment, we could say we're represented in this sector with XLV and IHI to a degree, and it also didn't keep up with the overall market. So we're going to exit that position, and we're going to maintain medical devices. This is really taking advantage of the demographic changes as baby boomers are aging, and it's kind of a secular bull market. And it's really outperformed the market over the last year, which is hard to do when the global market, the S&P 500 returns 31%. FDN, we were in this all for 2019 with names like Amazon, Facebook, Cisco, Salesforce, PayPal, Google, and Netflix. You think that this would be, riding high. The reality is it underperformed the overall market for the year. So we're going to exit that position as well. However, a similar fund, Sky, which represents it's really more cloud computing than the internet, more Adobe's and Salesforce type names rather than Amazon's. It outperformed FDN, and it outran the market as well. So we're going to maintain that position. Given some more recent conflicts in the world, we think it's a good idea to move to aerospace and defense, especially since the government has significantly increased the amount of money in defense and cybersecurity. We have an economic tactical that's in most everybody's portfolio. It's been healthcare and utilities. We talked about how in Q3, utilities really knocked the cover off the ball, and in Q4, healthcare really knocked the cover off the ball. We're going to maintain healthcare for the time being, but utilities, when You have a sector like utilities where you're expecting 4 or 5% a year, return 25%. You need to logically start looking around for something that might be cheaper. And the reality is, I think that we can have similar performance from something like an MLP position, which has an extra 1% dividend yield. So it's a little bit cheaper.
All right, well, with just a couple of minutes left, I don't want to take too long because I know we've talked for quite a while now, but I did want to mention a couple of recent developments, one of which was at the end of the year. It's part of the budget deal with between Congress and was signed into law. The Secure Act had some pretty significant consequence to, particularly to retirees and some business owners. When it comes, these are just a couple of highlights. There's a lot to the bill, the act. We did a seminar about it. I know Boyd and Boyd is doing a webcast that they had so much interest that they were unable to. Their kind of system blew up in the process, where it wasn't able to record their their real event, where they had about 100 people attend. So there will be another webinar on this topic. I'm sure that if you have an interest in, let us know. We'll be sure to make sure you have the link to get to it. In the meantime, the highlights would be if you had not started taking required minimum distributions in 2019, you do not have to start taking them until age 72, the year in which you turn age 72. For everyone else, if you'd already started, reached the age where you were required to take a distribution, you continue to have to take a required minimum distribution. It is, just as an aside, the table that they use to calculate the uniform table for the distribution requirements, that is changing next year, and it's going to make distribution amounts a little bit less stringent. It'll stretch things out a little bit longer based on your age. They'll assume your life expectancy is a little better, and that will make it a little more beneficial to you if you don't want to take as much out. Also, going back to the Secure Act, if you have earned income, sort of wage income or self-employment kind of income, and you're past the age of 70 and a half, you will be able to add to your IRA if you want to, or Roth IRA. That's not something that used to be you were precluded from contributing to those once you got past 70 and a half. Now that restriction has been waived, and you'll have the opportunity to add to it. In addition, the big thing that is on a lot of people's mind is that if you hadn't died in 2019 or before, the beneficiaries of your IRA, other than a spouse perhaps, they don't have the opportunity to do a stretch out where they could take it out over many, many years over their lifetime. They're capped after 10 years. So you can take it all out in the first year, out evenly over all 10 years, or all in the last year. It doesn't matter. But at the end of the 10 years, you're required to have the entirety of the benefits removed. Now, that's only for your heirs, let's say. And there are some caveats and some exceptions. If it's going to an entity instead of a person, it might be 5 years. Certain circumstances, you might have the opportunity to stretch it out over a lifetime, but they're few and far between. So for the bulk of the instances, it's changed to a 10-year time frame. For employers, I will mention that there are some issues that if you're starting retirement plans, there may be some tax credits available going forward, starting, I think it's next year. And, when it comes to your estate plan, if you're someone who had an IRA inheritance trust or a trust of that sort that was designed to own your IRA benefits after your passing, the rules changing with this stretch out make it likely that you're going to want to revisit that issue with your estate planning attorney. For those who do work with Boyd and Boyd in the office with us here in Hyannis at our office at AMR, they're Boyd and Boyd's office in the same office suite. You may want to set up an appointment to have a consultation with Boyd and Boyd to review that issue for your estate plan. When it comes to one other issue that people brought up at our live version of this, probably a good idea to talk about TD Ameritrade recently has been in the midst of acquisition from Schwab. And so that deal is expected to go through later this year, sometime maybe around midpoint this year, under review with the regulators, I think. Ultimately, it's probably that's going to happen, and it's probably that's going to take a couple of years before that has any material change in the way that all gets resolved. We don't think it's going to require anything of our clients to do any kind of paperwork or anything like that. It may create some system changes over time, but we'll be sure to keep you informed of that as it may develop. Brian, one last thought. You've been doing a lot to develop our stock strategies, and I don't know to what extent we want to talk about that here with the time, being what it is, but I would like to just whet the appetite of those listening. If they'd like to hear more about it, maybe we can just give them a mention of some of the things we're doing in those strategies, if you'd care to.
Sure. I think it's important just to let people know that it's available. I don't think it's been widely advertised by us. It's been relatively new. For about a year, we have really been emphasizing it and putting a lot of effort into it. It's a robust strategy. One of the advantages that you get from investing in individual stocks rather than funds is, you can try to take advantage of displacement in asset prices between individual securities. So even like today, when the domestic market's really expensive, well, maybe we can pick on a sector that isn't exactly keeping up with the market, keep our money invested in a productive way. And you can be a little bit more agile that way. So, I'd love to talk shop with anybody who's interested and talk stocks. Sometimes we get some great ideas from clients. So I love talking about it. So if you have any questions about it, if you have any interest, please give us a call, and I'm happy to have a longer conversation about the process and the discipline that's behind it.
Well, it's worth mentioning again here too, where the TD Ameritrade, along with some of the other firms, similar custodians, did away with the cost of trading of stocks, and exchange traded funds. It becomes more appealing in some cases to use stocks more, select in certain environments where there really is no cost for the trading of in and out of those, even if we have quite a few. Our portfolios, Brian, what do you think, about 35 stocks is customary in terms of the amount of number of holdings we might typically own?
Yeah, it's a moving target, but that's a fair average, yeah.
Ballpark. All right, well, very good. So big picture, Brian, I think, the commentary is right now things look a little better than they did last quarter and a little more optimistic. That being said, we have to be very attentive to those earnings and see how those earnings develop. And if not, that could be a driver that could cause some disruption in the market. We're very attentive to those things, and our active allocation process does cause us to adjust portfolios as things evolve and develop. But anything you want to highlight as we close out our comments?
Just one last thing. I mean, it might sound like that we think the market's overvalued and we're not making any changes. I just want to emphasize that we do think that there's a little bit of opportunity internationally right now, so we'll be moving in that direction.
Great point. Thank you. All right, well, as we wrap things up, let's just say if you need any help or you want to schedule a meeting, remember always too, this should take place in the context of your financial planning, and we want to make sure that we have that financial plan context fully considered. The portfolio is an important part of it, but it's not the only part of the big picture. So anyway, reach out to us at our office at 508-771-8900. Whether you're working with us on the Cape or elsewhere in our Dedham office, we can always route your call through that number. You can always go to our website as well at amrfinancial.com and we have the ability to connect with you that way. Let us know you want to schedule a meeting. Thanks, Brian, for all your hard work for the presentation today.
Thank you, Chris.